210. Right, welcome to actually it's a first edition of AlgoDynamix Podcasts. We usually have webinars, so we thought we'd spice things up a bit actually and do the audio only recording. And I was discussing with our host beforehand. We'll try and do it in one go, so no editing, no cheating, everything else actually. So we have two wonderful speakers. We have Frank Sortino and Tarun Khanna. Frank, is it working? Can you hear us? Do you want to say a quick hello?
I can hear you loud and clear.
Loud and clear, brilliant. Actually, loud. And same from Canada. Tarun, is this working? Can you hear us?
Yeah.
There we
Pleasure
go.
to be here. Yeah.
Welcome everyone else. So just a bit of background. I don't think Frank needs too much introduction. Tarun joined us a few years ago at AlgoDynamix. He's been quite instrumental at growing the business, growing the funds. We'll briefly talk about one of the funds we're running with Frank. But as I said, it's not a promotional event. It's accredited investors only, and today's more of a podcast about finance. So that's a bit of context. So thank you all for joining. So right, a bit of context. I've taken some notes here, so I've done a bit of research here. So long back ago, first stock market was actually in the Netherlands, Amsterdam. That was the very first one. Yes, you remember that was Frank. I think it was even before your time. There. You were there, Frank. So that was, the Dutch introduced the concept of, shared ownership, and it was related to their East Indies company. So they were colonizing the world, so they needed financing essentially. So that was their first stock market. First US stock market was actually Philadelphia, Frank. Did you know that? Not New York. It's Philadelphia. That was the first US stock market, the former one.
Then. Just outside of a bar, I think they had a.
Yeah, it was format, coffee houses or bar basically, and that's where some of the trading started basically. And then London was a bit later on, so that's on that one. So once again, just fast forwarding through times, stock markets were introduced possibly because of there was some international colonization going on basically. The other thing too, actually, one of the reasons was the railroads, transportation, industrials. This was a reason.
First securities were bonds.
Bonds, yes, yeah.
And it was sometime later that stocks became some. Equities, stocks were at the beginning given away to those bond traders who would sell the bond as a bonus, and then they started actually trading them.
Interesting, Frank. Thank you for that. So it was a dessert. It was a top up for the bond, was it? The equity?
Yes.
Well, that's always the argument.
Bonds were considered an investment, and stocks were either a speculation or a gamble, but you weren't allowed, a trust department was not allowed to buy stocks for widows and orphans accounts.
Interesting. Okay. And because the argument always that, the bond traders, so they speak, the bond traders like to think of themselves as more, what's the term here, Frank? As a bit more sophisticated. Yes, gentlemen. Yeah, thank you. Right. Interesting. So for the fixed income traders, everyone, there we go. We're looking after you. That's interesting. Okay, so that was given up, and then I guess later on it developed and it became a bit more liquid and traded. I guess with the equities, right, Frank? I'm assuming that's what.
Well, certainly in the 20s. The market moved from London to New York or to Wall Street, and at that time, the world moved around London. London was this market center. The sun never set on the British Empire. You remember that?
Back in the days, Frank. Back in the days, that's right. Yeah.
And everything moved. The world started to move around America instead. It became the empire that it is today, and Wall Street became the financial center of the world, and the exchange rate currency moved from the pound sterling to the dollar. Because at that time you could exchange it for gold at $35 an ounce.
$35 an ounce, and now it's about $1,800 an ounce, isn't it, Frank?
Yes, Nixon did away with that.
Yeah, gold standard. Yeah, that's another one, isn't it? God, heavy topic. So early 30s. So definitely, US, I guess, and then dollar definitely became the de facto world sort of reserve currency. Then I think that was the other move, wasn't it? Really. So
there are many in the world who think that has to change. That the U.S. has used the dollar as a weapon against those who don't do its bidding, And when America says jump, they're supposed to say how high. Uh, and the world doesn't want to do that anymore. The world wants to make its own decisions, and America can be a part of that if it wants. And that's still being debated in America, whether they should be a part or the hegemon.
It's an interesting one, actually, because that ties into sort of geopolitics and quite a few big topics, doesn't it, Frank? So it's a
Oh
fascinating in its
yes,
own right.
yes.
That's that one, really. So, wow. Okay, Frank, we're gonna leave that one. I'll say one sentence. I promise not to bring it up. I do not believe it's even a currency or reserve currency, but there's this thing called crypto making a bit of noise. Do you want to say one sentence about crypto, Frank, or not? You have a right to remain silent, as they say. So,
Well, something
yeah.
is going to replace the dollar.
Okay.
Now, I think various countries have been experimenting with a cryptocurrency of their own,
Yeah.
and China, for one, I, is Great Britain, is the UK.
They're playing. Everyone's playing, actually.
Yeah,
But Frank,
but
I'm not. Listen, I'm being straight to the point. Crypto's been good for us and everything else. Business. I'm still not convinced it's a currency, Frank. It's a currency in Latin America. In high inflation countries or in no central bank. But I think in most other places, it's not really a currency, is it, Frank? I mean, do you agree, disagree, or what's your view on that one?
well, I
Yeah.
think there needs to be some uh, basic uh, uh, currency that is traded everywhere,
Yeah.
and it shouldn't be under the power of one country. And uh, that's that could be a crypto form of currency that some maybe some group of countries would get together and decide that they're going to uh,
Group. Yeah.
that's going to be the exchange rate currency, and that would be a sad day for America because
Hmm.
uh, it is very dependent on its status as the exchange rate currency.
Interesting, interesting. Let's see how that goes, Frank. Let's see how that goes. I think the world is young still, anyway. So, gosh,
Uh,
okay, fascinating. So just going back to our stock markets again, actually. So, earlier days, depending on what was trendy, was it the industrials or the energy? S&P index got introduced in 1957. I've done my homework, Frank. I'm just going through my notes here. S&P. I think 2000 was probably the next interesting, at least from my perspective. Just going through the world history here. Obviously, the dot-com. I think moving away from industrials and consumer cyclicals and technology, and with the advent of the internet, Frank, I think that
yes,
that was the big one. At least I
that
think. I don't
was a
know.
big
So,
move. That was a structural change.
structural change. Thank you, thank you. I mean, here we are recording a podcast all around the world, basically over the internet, Frank. I mean, if that isn't structural, so moving away from railways to virtual communication, actually structural change, and it became one of the sectors of the S&P, and it's been roaring very nicely, hasn't it? Over that one, so lots of
Um,
yeah,
Certainly, there is a technology revolution
yeah.
that has been uh, recognized now around. Everybody knows that this is the driving force now. It's like the internet was back in 2000, you know. Uh, and I wonder if the next phase is on its way, and it might be the new computers that or the quantum
Oh,
computers.
yes, yes, yeah.
That's what 10 years away.
Well, I mean, Frank, shameless promotion pitch, and I think Tarun's going to pop up soon in a second too. Actually, we had a quantum implementation a few years ago already, so it's happening, Frank. It is happening. The
Wow.
trick with all these things, it's the when and the how, isn't it? A bit like the internet in 2000. We sort of figured out there would be something going on with the internet, but we couldn't figure out the details, and here we are. So it's the details. I think the when and the how,
Oh
basically.
yes, yes.
So I think
Well, right
that's
now it seems to be the chip companies that
yeah.
everybody is talking about, and uh, I I have a difficult time seeing that as the driving force. I mean,
Mm.
yes, chips are getting bigger and better, but it's what you do with that chip uh, that is really going to make the world different.
Yeah,
Uh,
absolutely. I like that. So a bit of a bricks and mortar analogy. The chips are the bricks and the mortar, but it's the houses, isn't it? That's the ultimate end
Yes,
result, isn't it? Really.
yes, I think so.
Nice analogy on that one, really. So, okay, so chip companies. I mean, yeah, I said chip technology. So, once again, Frank, bring it back to finance. So, I think we've had these discussions. We've been doing stuff together for a long while now. Picking stocks individually is difficult. I think picking sectors and indices is much easier. Am I putting mouth in your words in your mouth here, Frank? Do you agree on that one, or what's your? Sorry, it's too
Well,
easy.
certainly,
Yeah.
stock picking has been a favorite, and for some time. It started sometime in the 30s.
Wow. Already. Yeah.
That accounting was applied, and so
Yeah.
the people could use the balance sheet and the profit and loss statement to pick winners in the market, and that worked until everybody was learning the same ratios. If you went to any university in the world, you learned the same accounting principles that were taught, and so the cash flows are cash flows, no matter where you're learning it. And so everybody was doing the same thing,
Mm.
and everybody was picking the winners the same way.
Yeah.
And then along came the computer, and it said, you know what? Uh, all that information is already captured in the price. So you're wasting your time looking at the accounting principles that everybody knows. And everybody knows what the good stocks are, and everybody knows what the bad stocks are. And so they bought all the good ones and ran them up to prices that were far more than they should have been. And everybody sold all the bad ones that they knew were bad. And so there was a time, remember, when you bought the dogs of the Dow, that you just bought the worst stocks around, and everybody knew because they were oversold.
They were oversold. That's right. Yeah.
Well, and now it's a question of can the computer that was developed in the 50s, the capital asset pricing model came along and said markets are efficient, and so don't waste your time uh, calculating those ratios, because we can develop an efficient frontier of stocks that you can pick then that point on the efficient frontier that would be just right for you because it's where your utility function is tangent to the efficient frontier. That one spot would be the portfolio for you. And then Bill Sharp came along and said, wait a minute, under general equilibrium conditions, you know what there's someplace in the universe is a place called equilibrium.
Hypothetical equilibrium, Frank. That's right. Yes.
Yeah.
One spot in the universe. That's right. Yes. Yes.
If we have general equilibrium conditions, and you have to make a few assumptions in order for that to be true, that all investors are single period expected utility of terminal wealth investors who make their decisions based solely on the first and second moments of a standard normal distribution. Now, if all of those things are true, then the capital asset pricing model works. Unfortunately,
That's a big if, isn't it, Frank? That's a really big if,
none of
isn't
them
it?
are true.
Yes. I know.
None of them hold in the real world. But if they
Right.
did, then that would work.
Yeah. I think the devil's in the detail, actually, and it's. How do I put this nicely, Frank? Frustrating, especially for dare I say the younger kids like ourselves. Is like, okay, your theoretical equation sort of holds, but it doesn't hold in the real world, which is annoying. It's beyond annoying, actually, Frank. It's like, well,
Yes.
it's nice theory, but then
Human beings. It's those human beings that keep messing everything up. And we can't figure them out and what they're going to do. Well, maybe the new psychology can figure us out. But I really think that you're at the cutting edge. That it's AI that's the new driver, the new driving force, and you're going to have to depend on it for at least part of your decision making in order to compete in the world.
Absolutely. I think your point about the humans, Frank, just to reiterate that, it's humans are not known to follow, a bit like supply demand economics, optimum supply demand. then I've seen this in practice, Frank. You overprice it, and you suddenly get more demand. Humans are the least rational things on this planet. So I don't know why people want to put us in a rational block.
Except for you and I.
Except for you, yes, obviously, Frank. And everybody listening to this podcast, yes, but everybody else is sort of, that's on that one, really. So yeah, no, I think, Frank, back to your point again about the chips. The chips are there, they're the bricks and mortar. The houses are the AI. I guess being a bit self-promotional here. It's the use cases. What do we do with the AI? How do we apply it? And I think absolutely spot on, basically. So that's where our money is. And then just a bit of context. And I know people are probably familiar what we're doing at AlgoDynamix, but just it's behavioral forecasting. It's all the irrational bit. It's capturing anything that doesn't fall inside a standard equation, which, when you think about it, is quite a huge component, isn't it? So that's what we're doing.
Yes, humans keep making the same mistakes over and over again, and not learning from their experience.
Because we started, in intro session to this podcast, we started with the first. I think the tulip bubble was 1600. When was that first bubble? With the I think even Isaac Newton got.
Oh yes.
And then there was a South Sea bubble. There's quite a few bubbles. I mean, every period's had this bubble, right? .com bubbles. There's always been a bubble, but it
was a banking bubble.
There's a banking bubble too.
The banks broke.
Yeah, 2008. Yeah, so bubbles. Yeah, but anyway, it's and dare I say, love it or hate it, it's some argument that most of the crypto actually is bubble-esque, if that is a term. It is entirely behavioral. There's usually not much very often no fundamentals behind it, right? So there's very. Frank, is that a word, bubble-esque? I don't know. We need to invent a new terminology here, but
bubble-esque.
Bubble-esque, prone to bubbles. There we go. So that's on that one. Crypto falling squarely.
Certainly, we had our own form. The last one was 2000, with the derivative instruments that were developed. Again, there were a large set of assumptions that this instrument is just like that instrument, just like a stock. And so you can trade this piece of paper instead of this piece of paper. Well, that turns out to not be true either. That these instruments of destruction that were developed.
That was more towards 2008, isn't it? With all the popular assumptions, and we can look back, Frank, and think it's ridiculous now. But I don't know how. But at the time, I guess I don't know, Frank. What's your explanation about these 2008 collateral debt? All these instruments that sort of made no rational sense whatsoever. I guess I don't know. Was it just commercial pressures, Frank? What's your view on that? How did we get there in terms of global financial crisis? Yeah.
Well, it was the whole idea of the Black-Scholes options pricing model. That you could create a put or a call. That made sense. That it was very similar to the underlying stock.
Yeah.
If you bought a call for the 30 days of the call, so it had a time element that it was the same or very similar for that period of time.
Yeah.
But the person who bought the stock could wait past the 30 days and past the month or two or year or 3 or 4 and hold on to his stock. The call option expires at a certain date, and it's either worth nothing, and most of them expired worth nothing. By the time the expiration date came, the futures price and the cash price were the same.
Yeah. And then whatever happened to the options, right? I think, but that's an interesting one. So yeah, interesting one. Options. I think one of these financial innovations, right? I'm just looking at that one. So
yes,
that's on that one. And as I said, did not want to make this about this whole new crypto thing, actually, but that's another form of innovation, I would say. It's a volatility play, Frank. I think that's what it is, basically. But I think we're just mentioning that one briefly. So okay, good. So then, Frank, just moving on slightly, actually, because we're sort of having way too much fun down here. As I said, once again, we have to be a bit careful not to sort of solicit anything else. But there's a stock market fund we've all been working on, which is for accredited investors only. So Frank, do you want to give us a bit of context? How did we get here? How did you become an actual fund manager over the past few years? So to take us back to the initial days of yes.
Not too many years ago.
Not too many years ago.
I took a class at Stanford, introductory course in artificial intelligence, and from Ron John Nog. And in that class, he mentioned this group of people over at Cambridge that had developed some AI model that looked at what was going on in the futures pit of the buying and selling, and using cluster analysis and all these things that I had studied, and they were using artificial intelligence to tell when the group in this cluster were going to be buying and when they were going to be selling. And I thought, wow, that is, I wonder who that person is. So I got your name and I sent you an email and I said, this sounds like this is the new world. And I'd like to know more about it. And then you put me in touch, and put Ron, John, and I together to do some research on that. And been very exciting for me to be a part of that.
Yeah, exciting actually. So that was that. I think that good combination too, actually, because Frank, it sort of builds also on the work you've done in terms of post portfolio. So I think we've combined a few techniques. We've combined the forecasting from AlgoDynamix. We've combined your it's probably a bit too heavy, Frank, but in terms of your sector allocation with TPR. And I think we're not going to talk too much, but buy the book. There'll be a link to Frank's book. Frank, is that okay? I think they should buy your book. How's that? Yes, buy the book.
Yes, I've made hundreds of dollars on those books.
Okay, good. It's a nice book. Go and buy the Frank book.
Please,
there we go.
buy another book.
Buy another book. Actually, there'll be a research note. We'll be releasing a white paper too, actually, on the back of that in terms of allocating. But it's lovely work, Frank, in terms of breaking down the S&P in different sectors and then just overweighting.
My contribution to this has been to find a better way to manage the uncertainty in financial markets in terms of probability distributions. And instead of making decisions based simply on the probability that it'll be a good outcome or the probability that it'll be an outcome, a bad outcome, I've separated that into upside potential and downside risk. So that's my contribution.
That's your contribution. So upside potential, downside risk, and then on a sector level, because I think love or hate the S&P, it's more interesting at a sector level. So working at a sector level, which avoids the single stock problem too, doesn't it, Frank? So I think well done.
Yes, I think diversification is a crucial part of the portfolio management decision, and I think those breaking up the S&P 500 into those 11 sectors. And then looking at each sector, the upside potential relative to downside risk of each sector has worked very well in identifying the ones that should do well and those who have more downside risk than upside potential. Leave them alone.
Yeah, leave them alone actually. So that's on the portfolio construction side, and then we're using AlgoDynamix in terms of when to sort of get in and out type thing. So lovely thing. So yeah, the fund's live. Been running for a few years now. As I said, once again, accredit investors only. It's not a solicitation, but it is just to sort of share the great work we've been doing actually in terms of setting up an AI equity fund, long only on leverage AI equity funds. So we've been busy in that one. And as I said, there'll be a research note coming out very, very, very soon on that one. Probably time it with this podcast. So that was a very brief overview. Now I'm going to ask Tarun actually, but by the power of the internet, Tarun's going to suddenly reappear from Toronto. So Tarun, go ahead. There we go. Okay. So Tarun, just summarizing. So working hard on the AI fund. Quite a few bits we're doing there actually, and maybe Tarun can give a bigger picture of what else we're doing at AlgoDynamix. As I said, this AI forecasting, it's not going to go away. So I think Tarun's been quite instrumental at sort of growing the various businesses. So Tarun, go ahead, unmute yourself, don't be shy.
Thank you, Jeremy, and thank you, Frank, for taking the time to speak with us today. Hi, everyone. I'm Tarun. I'm the president of AlgoDynamix North America. I run and manage our North American business. I think maybe I'll just give you a brief overview of the different businesses that we're involved with here at AlgoDynamix. As Jeremy mentioned, we have a traditional software business where we provide price forecasting for the financial markets, the equities markets, commodities markets, and the crypto markets. We sell our software to a variety of clients, including high net worth accredited investors, tech entrepreneurs, small and medium sized family offices and hedge funds as well. If you would like to try out our software, we offer a 3-month trial. The cost is 3,000 US, and we provide you analytics for about 20 stock symbols if you're trading equities. And then we also co-launch new hedge funds with small and medium-sized hedge funds that are looking to grow and expand their business. We launch equities funds, crypto funds, and commodities funds. And basically, if you would like to find out more information about our software, technology, partnership businesses, you can reach out to Jeremy or myself. You can reach Jeremy at algodynamix.com or Tarun at algodynamix.com, and we'd be happy to chat with you further. And I think that's about it from my side. I'll turn it back over to Jeremy. Thank you.
Brilliant. Thank you, Tarun. I think it's just, that's sort of the partnership model, actually, we like a lot, actually. And then delighted to be sort of working with people like Frank, actually, sort of just combining different technologies, absolutely amazing. And then starting new funds on the back of that. So it's definitely probably the most exciting thing. So Frank, you have the last word. Do you want to give us some final tidbits, because it's been extremely interesting? Yes,
a bit of wisdom.
Bit of wisdom, Frank. Yes, from back from the Crimean Wars. When were you? Go ahead, Frank. Yes.
I have opinions on almost every subject that comes up. And I give up those opinions very quickly. Change my mind often on my various opinions of the market. But sometimes some of those opinions have evidence to support them. And those become my belief systems. So there was a time when I believed in generating an efficient frontier in a mean downside risk framework. And I created a computer program to do that. And then I retired and wrote a book, and then I started applying that methodology, and retired again and wrote another book. And then I met you, and here I am working again, because I'm enjoying very much this new development that I think is going to be extremely important. It will be a driving force behind portfolio management. The application of artificial intelligence to that decision-making process.
As we're proving, yeah. Thank you for that, Frank. So there we go. You've heard it from Frank. I'm going to finish on that note. Actually, I don't want to sort of dilute anything else, but Frank, you as always delighted. We might have to sort of ask you back again next year, actually, Frank, with this sort of insights. But it's been absolute pleasure. So thank you all for that. Tarun, as always, pleasure. So I'm going to switch off now, and please do get in touch with us. So over and out from AlgoDynamix. Stop the recording.